Hello, hello, hello. Welcome to Al Stock Trades. In this video, this is going to be a nice and juicy one. So I want you to listen up, pucker up, because I am seeing some pieces being put together that might state that we are slowly entering a cautiously optimistic bull market. Yes, you heard it correctly. We might be entering a cautiously optimistic bull market. Now, the best example I can think of right now is for all the Yu-Gi-Oh card players out there back in the day when we were kids. You know how you have to have 5 of the Exodia pieces to get them all to basically go ahead and win the game, right? Well, that's exactly what I think of this kind of exiting a bear to going into a bull market. It's looking like that a recession may not happen. We will see regarding the inventory spikes and all of Walmart and Target having these issues and possibly hitting their gross profit margins and yada, 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 affecting their employees, and they have to go ahead and cut jobs. But what I'm seeing right now is I'm seeing something really tall-telling, a data point, multiple data points that are aggregating, and especially using our hedge fund information, I would like to share with you. We just had the CEO of Chase, remember, a hurricane's coming, to basically saying, this bull market has legs. Now, for all the people that don't know, this is kind of a common saying. It means that it has a leg to stand on. It is stable, and it is going. So I'm going to go ahead and give you guys some education like always and check this out. All right, so if you look at this right now, tech shares have been coming back through a vengeance. Normally, when we look at this green line here, this is a 20% run off of a 52-week low. Again, remember I told you, I keep saying this number, June 14. Remember when smart money and dumb money were at its opposite levels? It all started here and a little bit also in May here, but we went from June 14 to 37 days. Remember 37 days, it's greater than 30, right? 37 days going up in the market. We have been basically increasing, okay? Now, why is the dates why do they mean anything, right? So normally, the number of trading days of a tech sector to rally 20% from the 52-week low is around 21 trading days, okay? Now, we basically hit the average right now. Maybe Michael Burry, right? I've messaged him before, and I hope that he helps us with the mastering course as a second, he was a physician before, but he was looking at this indicator right there that it took longer for this, kind of like bull market to come back, right? And this was during these inflationary times, was around these particular statements. But it looks like that we may be exiting this bull market. And there's more data points. This is just one, okay? Now, like I stated, when the technology sector rallies 20% from its 52-week lows after 30 days, longer rallies tend to have more staying power. And if you look at the 3 months, 6 months, and 1 year, you can see that after a year, this is just the aggregate data from 1931 to 2022. We did get a signal here, and if you look at the aggregated data, a year from now, it is looking like we are going to be in the positive, okay? Now, if you look at rallies that are 20% from their 52-week lows within the 30-day spectrum, well, that is a traditional bear market rally. That is Wall Street trying to cover their shorts, trying to basically disengage from the market, right? And then things go back down. And that usually happens within 30 days. And you can see the dates here in the data, and as you can see that it's not that's not what you want. However, we just entered a couple days ago that 30-day mark, okay? And that's what Jamie Dimon was saying when he was basically going off and saying, hey, this rally has legs. Listen, Wall Street's looking at this right now. Wall Street is like, whoa, what do we do here? And they're ready to deploy their cash, okay? And I'm just letting my retail investors know this is what's on their mind, okay? So now we're going to go ahead and look at our composite thrust model, which is extremely accurate, that basically goes ahead and shows you whether we're entering a bull and bear market. We just got a buy signal right now at 2022, a couple days, like within the past three days, we got a buy signal. And the last time we got a buy signal was November of 2020. Okay. If you aggregate this data, we are looking extremely sexy that we may be exiting this bear market. In fact, if you look at the, let me go ahead and pull this out, this specific data point here. If you look at this, and if you look at August 12, where the model spiked up, we are seeing a cautiously bull market signal, okay? Now, let me go ahead and see if I have, I also have this to share with you. So if you look at the economic surprise index, this is extremely important because whenever you have economic data, you have analysts projecting economic data and you have the actual real economic data. Whenever you have a disparity, it equals a surprise. And this is a surprise to the positive side. We've been getting some data points that have signified that inflation has peaked. So there's other YouTubers out there that are also calling that, hey, we're going to be entering a bull market. And now with this sufficient data that I am standing behind, it seems that this may be true, okay? So if you look at the economic surprise index here, whenever we get surprises that are outside of analyst expectations from the economic analyst, not the financial analyst, we start to basically see the surprise. And usually we get these signals here when we have a lot to run. As you can see, a year from now, we could be running an average return of 18.23%, which is basically, if you look at it, for the S&P 500, that's a pretty damn good deal, okay? And these returns are enormous. Like last time we had the signal, it was June 3rd. You remember June 3rd when we had that? Again, I have photographic memory. You remember June 3rd when we had that that dip? We had a dip in June 3rd, and everyone thought that was going to be the crash right after the March crash. Well, we had a signal, and we said, hey, no, things are going to look good. And then if people that sold out of that and they stopped with the market, I remember I stopped buying 3-4 months after that June of 2020, right? But that was incorrect, right? So I want to make sure here. And lastly, if you look at the put and call ratio, it's very important to understand that you want to do opposite of what retail is doing. Right now, a lot of them are putting in puts. They're very bearish. You have to understand, do the opposite of what other people do. A lot of them are saying, no, I don't believe in this. Once you get that ingrained into their DNA, this is amazing. This means that the psychology has gotten into their minds. So it seems to me that we may be going up from here. Now, again, we need more data. Remember I told you in the beginning, it's 5 pieces of the Exodia card. I think right now we have around 1 to 2. We need a couple more inflation reads to see if these 75 basis points are working. It seems that the stock market's going to be out looking more towards the future, and things are going to look sexy. Likewise, it may seem that the housing market may take a deep hit in areas that are hot, such as Tennessee, Texas, Phoenix, Arizona, X, Y, and Z. So I hope that this was helpful. If you like this content, if you like the analysis, we are giving out a $150 off coupon called Labor150 for our Mastering Stock Market course, which you can find at alstocktrades.com. Here is more information regarding what we offer. We've been featured on Bloomberg, NASDAQ, Yahoo Finance. We are the real deal. We work hard for our members, and we want to basically help retail investors get a fair shake on Wall Street. Okay? So if you like this video, don't forget to hit that like button, subscribe, and please tell me what you think. It is a privilege and honor, and I'll see you on the next one.